Saudara pemirsa OT TV dan mahasiswa Universitas Terbuka dimanapun Anda berada, selamat berjumpa dalam program tutorial TV mata kuliah Manajemen Perbankan Syariah dengan kod EKSA4402. Pembahasan dalam kesempatan ini mengenai Islamic Banking Financial Reporting. Bersama saya Professor Sahraman Haji Latif. So we will discuss about financial reporting of Islamic banks. So what are those the components of financial reporting? So usually there are components of Islamic financial banking reports, or usually what are those reports that can be reported by financial institutions like Islamic banks. They should report because this is mandated by the central bank, or they should report because this is important for the stakeholders of Islamic banks, or particularly for the clients or for our society. So what are those reports that they need to report for the society or for the stakeholders of the Islamic banks? So in fact, not only Islamic banks, even the conventional banks also are required to have this financial reporting. They should have these financial reports. So usually there are components that Islamic banking reports. First is what we call the balance sheet. They should have reports regarding the balance sheets of Islamic banks. The Islamic banks should have reports on their balance sheet. What is meant by balance sheet? This is the statement of financial positions. They should report to the stakeholders or particularly to the public regarding the status of their assets, the assets of Islamic banks or conventional banks, for example, because as I said, financial reporting is not only for Islamic banks, even the conventional banks, they should report. So what are those components of financial reporting? So one component is what we call the balance sheet. Balance sheet, sometimes it is called the statement of financial positions. This comprises of assets, liabilities, and shareholders' equity. So in other words, Islamic banks should report. The reporting can be annually. Usually it is annually. It can also be quarterly, depends on the financial institutions, but usually, mostly, as you observe, annually. If you go to the website of financial institutions, Islamic banks or conventional banks, you can see that they have these annual reports. So in annual reports, that is there is an financial reports. So you can see in their annual reports the balance sheets. The assets, what is the total assets of the Islamic banks, the total liabilities, and also the shareholders' equity. So in balance sheets, we can see the status of the assets of Islamic banks. We can see the liabilities, the obligations of the Islamic banks. We can see also the shareholders' equity. So that is one component of financial reporting of Islamic banks. Balance sheet. Balance sheet, it is the overview of the company's financial conditions at a specific period. In other words, as I said, it presents the company's assets, liabilities, and shareholders' equity. So another component of the financial reports of reporting of Islamic banks is the income statement. Or when we say income statement, this is the profit and loss statement. This report shows revenues and expenses of the bank or the company or financial institutions. So income statement, you can find in the income statement the how much the revenues or the profit of the financial institutions like Islamic banks or the company. If they so in income statement, we can see in the income statement the revenues of Islamic banks. And we can also see in the income statement the expenses of the company. What are the expenses of the company? So that is the income statement. So that is the second component of financial reporting, income statement. So we have the balance sheet, and again we have this income statement. Another component of financial reporting of Islamic banks is statement of cash flow. These cash flows, it's used the operating activities. What are the operating activities of Islamic banks? What are the activities of Islamic banks? What are those investing activities of Islamic banks? Where they invest? And also what are their financial and other financial activities. So we can see in the statement of the cash flow of the financial reporting of the reports of the Islamic banks, their statement of cash flows. So when we say statement of the cash flows, this is about the operating activities. What are the operating activities of Islamic banks? We can see their investing activities and other financial activities. So that is another component, statement of cash flows. We have also a statement of changes in equity. Statement of changes in equity, this use the changes in the bank's equity over a specific period, and we can also see in the statement of changes in equity the retained earnings of the Islamic bank. So in statement of changes in equity, we can see the bank's equity over a specific period, and we can also see there how much the retained earnings of the Islamic banks, or if not Islamic banks, or financial institutions. So those are other component of financial reporting. So we have the balance sheet, we have the income statement, we have the statement of cash flows, and of course we have the statement of changes in equity. Sometimes there are other components of financial reporting like segment reporting, which is use the other business activities of financial institutions like Islamic banks. So those are the components of financial reporting, financial banking reports, in not only for Islamics but even the conventional banks. So they should report about balance. They should have this balance sheet, report their balance sheet, the statement of financial position. They have this report or statement on profit and loss. They should have this statement of cash flows, statement of changes in equity, and of course other reporting like other business activities. So why we need to have, what are the objectives of financial reporting? Why we need to have financial reporting? Why Islamic banks or financial institutions are required to have financial reporting? We can say that we have specific objective. There are specific objectives. We have this also a general objective. So why financial reporting is necessary. In fact, we have also a qualitative objective. But for specific objective, of course, this is in compliance with the generally accepted accounting principles that there is what we call the financial reporting. So financial reporting is necessary because this is part of generally accepted accounting principles that there should have a financial reporting. For general objectives, there are many reasons why we need to have financial reporting, or why Islamic banks need financial reporting. They should report regarding their balance sheet, income statement, statement of cash flows, statement of changes in equity, and other business activities. They need it in order for to provide transparency and accurate information about the financial performance. So they need to provide the financial reporting because this is an important for transparency. To give the transparency about to the stakeholders of Islamic banks or financial institutions, for example, about the transparency. What is the operations of the financial institutions or Islamic banks? So the purpose is for transparency, to provide transparency. That's the one objectives of general objectives of financial reporting, to provide transparency. And of course, to give an accurate information about the financial performance. So, to update, to inform the society, the stakeholders of the Islamic banks about the status of the financial performance of the banks, and of course, their positions and activities. And this is very important for the stakeholders, particularly for the public, to know about this. Another reason, general objective of financial reporting is, of course, this will provide information for investors and potential investors. So, this is also necessary. You know, for investors or some clients, or they need financial reporting. And this financial reporting, they need financial reporting of financial institutions. For example, investors of Islamic banks, they need the financial reporting financial reporting. They need to have to be provided with information regarding the financial status, performance, positions, and activities of Islamic banks, because they are investors, or for those who want to invest, they need to know this, because this will encourage them or motivate them to invest. That is why in the Islamic banks, or to deal with Islamic banks, if they know the financial reporting of the Islamic banks. So, financial reporting is necessary because this will motivate the potential investors to deal with the Islamic banks. Financial reporting also is necessary because this will provide financial reporting can be used to forecast the profitability of the business. So, financial reporting is necessary also because we can forecast this forecast the profitability of the business or Islamic banks. We can see if the Islamic banks are profitable. We can see if the financial institutions are profitable after we are provided with the information or financial reporting about those institutions or about that institution. So, it is necessary. Financial reporting is necessary to forecast the profitability of the business. So, of course, there are also some qualitative objectives. For example, relevancy, understandability, verifiability, neutrality, and timeliness, compatibility, and completeness. So, those are the objectives of financial reporting. So, we have the specific objective, general objectives, qualitative objective. But for general objective, of course, is because this financial reporting is important for transparency and accurate information about the financial performance, position, activities of Islamic financial institutions. This will provide information for the investors and potential investors. Financial reporting is necessary because it can be used to forecast the profitability of Islamic banks. So, although the components that we have mentioned is good, is also for conventional conventional banks. Sometimes there are differences between the components of financial reporting of Islamic banks and conventional banks. Generally, for conventional banks, they have this balance sheet, income statement, statement of cash flows, statement of changes in equity, other business activities. But for Islamic banks financial reporting, there are additional reportings. For example, the statement of source and uses of zakat, because Islamic banks sometimes they have this zakat. So, in their financial reporting, while in conventional, they don't have this statement on zakat. But in Islamic banks, they have this zakat, or sometimes they have sources from zakat. So, they should report this in their financial reporting, the statement of sources and how they utilize the zakat. While in conventional, we cannot find this financial reporting. But this is only for Islamic banking financial reports. So there is, in financial banking reports, there is a statement of source and how they utilize the zakat. There is also sometimes an need to report in Islamic banks. For Islamic banks, they need also to report or to include in their financial reporting about the statement of changes in restricted investment funds regarding the profit loss sharings. So because in Islamic banks there is a profit loss sharings, so compared to conventional, in conventional there is no profit loss and sharings. But in Islamic banks there is a profit loss sharing, so they should report this also in their financial reporting. The statement of changes in restricted investments, particularly in mudarabah. They should also report for Islamic banks. They should have also reports regarding the statement of sources and uses of welfare funds as required. Those other sources like the welfare funds, like the infaq, the sadaqah, the penalties, for example, maybe they imposed penalties, and these penalties cannot be used by the bank. And this will be used for the welfare funds. So they should report this, how the sources and how they use this infaq, sadaqah, and the fines or the penalties they imposed. So while in conventional or other sources which are not halal, for example, they incur non-Sharia compliant, they got some sources or funds from a non-Sharia compliant activities, so they should report in their financial statement. So this is the uniqueness of Islamic financial reports. In conventional, not necessary to report, because the conventional, they don't talk about what is halal and what is haram. But in Islamic financial reports, there should be a zakat, there should be an statements or report regarding the statement of changes in restricted investment funds, and of course, the statement of sources and the uses of the welfare funds, like infaq, sadaqah, and penalties, and other non-Sharia compliant funds. So those are the components of Islamic bank financial reports. So you can see in some, if you open into some financial reports of Islamic banks, you can see in their reports about these components. While in conventional, you cannot find some of the financial reports of Islamic banks cannot be found in the conventional banks, like zakat, the use of welfare funds, the statement of changes in restricted investment funds. These three usually can only be found in the financial reporting of Islamic banks. So you can see this in the annual report of Islamic banks, or even in the financial reporting of conventional banks. These components, statement, this component, balance sheet, statement, income statement, statement of cash flows, statement of changes in equity, or other business activities. For Islamic banks, there is a statement of source and uses of zakat. We have the statement of changes in restricted investment funds, and we have also a statement of sources and uses of welfare funds. So those are the components of financial reporting of Islamic banks. Demikian materi mengenai financial reportings of Islamic banks. Semoga bermanfaat dan selamat belajar. saudara bersama OT TV dan mahasiswa Universitas Terbuka dimanapun Anda berada. Selamat berjumpa dengan program tutorial TV mata kuliah Manajemen Perbankan Syariah dengan kod EKSA4402. Pembahasan dalam kesempatan ini mengenai risk management bersama saya, Profesor Sahraman Haji Latif. So we will talk about what is risk and risk management in Islamic banking and finance, particularly in Islamic banks. So because it is about risk management, so let us first define or know what is risk. So when we talk about risk and what is risk management, so we need to talk about the risk. Risk means uncertainty, or that is undesirable outcomes or hazard. So that is what we mean by risk. It is an uncertain, that is or the probability that something bad events, or the probability that something bad will happen that results or creates sources of loss or liability, injury, or damage. So that's what we call an risk. So the probability that something bad will happen or bad events will happen that will result or create loss or give loss or liability, injury, damage to the bank or to the organizations. So, or it can be also an uncertain of the future that is results losses. So that is a risk. So why Islamic banks need risk management? Why we need to control or manage the risk? Because the risk is about the uncertainty. But if this uncertainty will not be managed, then it will give a negative impact or liability or loss onto the bank. So there is a need. So if there is a loss, there is also a damage so to the bank. So this will impact this will give a negative impact to the profitability of the bank or the operation of the bank. That is why risk should be managed properly. So there is what we call a risk management. So in Islamic banks, they have this risk management. In fact, not only in Islamic bank, even the other financial institutions, particularly in financial institutions, they have this risk management in order to how they assess or identify the risk in order to avoid it. So the purpose of having a risk management in Islamic banking or in Islamic banks is in order that to avoid or reduce or mitigate the negative impact of the risk. So the risk management, so we defined already what is risk. So we said that the risk is in uncertainty. Risk is the possibility that something bad or something bad events will happen that results or create a source of loss, liability, injury, or damage. So this should be avoided. So there is a division in Islamic bank, what we call risk management, or there is a process or a way on how to mitigate, how to reduce this risk. So we call it risk management. So risk management is the tool or the process or the way of identifying, assessing, controlling, and reviewing risks. So this is what we call the risk management. Risk management is the tool, it is the way, or it is the process on how we identify, the Islamic banks identify, assess, even control, and review risks. So in order for the bank to avoid, reduce, or mitigate the impact of risk. So that is what we call risk and risk management. So why we need to why we need to manage risks? Why Islamic banks need to manage risk? Why some organizations or institutions they need to manage the risks? Why they need to manage uncertainty? There are many reasons behind of why Islamic banks, why some financial institutions need to manage risks. One reason is in order to have a vital good decision making. If you have a risk management, if the banks have an risk management, then they can make a good decisions in their operations, on their banking activities, because they can identify, they can control and assist the risk that will give a negative impact to their operations. So by having risk management, this will give a good decision to the institutions. So that's the one reason why we need to have and to manage the risk. To manage the risk. Another reason is this is also important for planning. If you know already, if you can determine, identify, control the risk, then this will give to the Islamic banks to have a good planning in each operations or in their operations. Another reason is risk management is needed, or we need to manage the risk, because risk, if having to manage the risk, if you manage the risk, then this will give an positive impact to the savings of the banks or Islamic banks. Because risk will give, if not managed properly or effectively and efficiently, then it will give losses or damage to the bank. So if the risk will give a loss or damage to the bank, then this will decrease the savings of the bank. So by having a proper management in the risk, then this will give positive to the savings of the bank. This will increase the savings of the financial institutions like Islamic banks. Another reason why we need to manage risk is because this is compliance of the regulations. Usually, the central bank of the certain country, like Indonesia, for example, the Bank Indonesia, of course, they required financial institutions like Islamic banks to have a risk management. So we need to manage risk because in compliance with the regulations of the monetary authority, or what we call the Central Bank of Indonesia or Central Bank of the country. Another reason why we need to manage is because this will maintain the organizations or institution reputations. This will, if the institutions cannot, or financial institutions like Islamic banks cannot manage the risks, then this will give a negative perception on the consumers or the clients or on the society regarding the reputation of the bank. In other words, the reputation of the bank will be damaged when the bank cannot control its risks. So we need to manage the risk, because in order to maintain the good reputation of the bank or Islamic banks, we need to have a risk management, of course, to reduce the negative impact of the risks, because this is an uncertainty that if this will not be happened, then it will give a loss or damage to the financial institutions or to the Islamic banks. So by having risk management, then the negative impact will be reduced, or the risk will be reduced. Another reason is because we need to have a risk management, or we need to manage the risk, because to protect our customers, to protect the customers or our clients. Because if there is a high risk, then this will give a high losses to the banks. Then if the banks will be having a big loss, or then this will give a negative impact also to the clients or the customers. In the case of Islamic banks, or in the case of financial institutions, to the depositors or the stakeholders of the bank. Another reason is because it will help the economy. Risk management, we need to manage the risk, because this will help the economy. If the banks cannot manage the risk, then the bank will incur losses, then its profit will be affected, then it will also affect the economy of the country. So we need risk management. Risk management is necessary, of course, to increase the profit. If the bank will incur a less loss or no damage because the risk is managed properly, then the bank will have a high profit, or its profit will increase because there is no cost incurred on the risks because the risks are managed. So the profit of the bank will be increased. We need to manage risk management, of course, because this is to reduce the negative impact of the bank negative impact of the risk, as I said earlier. So that's the reason why we need to manage risk. So there are risks incurred. There are risks for conventional banks and even Islamic banks. There are risks that are both for conventional banks and Islamic banks. In other words, there are risks that can be encountered by the conventional banks or even Islamic banks. What are those risks? Some of those risks that can be encountered by conventional or Islamic banks are, for example, systematic risks. Systematic risk this is the probability of something or bad that will happen that give negative impact or loss to the banks or financial institutions, both conventional and Islamic, is the systematic banks arising because of these uncontrollable circumstances. These systematic risks are like interest rates, inflation risk. Inflation, sometimes you cannot control. The banks or financial institution cannot control this risk beyond their control. That is why this is an external factor, what we call systematic risk. For example, recessions. When the economy is not good, the bank cannot control this. When there is a high inflation, then the bank also cannot control this. But this inflation can give a negative impact because this is a risk to the banks or to both conventional and Islamic. So this is what we call examples of what we call systematic risks. We have also risk, what we call liquidity risk. This is the risk that will be encountered both by the Islamic banks and conventional banks. This arises because the banks, conventional banks and Islamic banks cannot able to meet its obligations. You know, Islamic banks or financial conventional banks, they have these obligations. Obligation, for example, the depositors, they deposit their money into the banks. So when they withdraw it, the bank should have money to give it to the depositors if they want to withdraw their money. So sometimes the banks cannot able to meet its obligations. They cannot able to give it immediately, or because there are problems of the liquidity. So we call this one as liquidity risks. This is a risk that arises because the banks fail to meet its obligations in due time. Another risk is what we call the market risk. This is the risk encountered by both conventional and Islamic banks relating to the markets, the situation of the market, particularly the prices of the commodities. Another risk is what we called, we have this credit risks. Credit risk is, this is the risk that will encounter by the bank that arises when the counterparties delays in payment. When there is a counterparties delay in payment. In other words, the counterparty cannot able to meet their obligations. In other words, when you say credit risk, this is default risk. In other words, defaulting paying the obligations of the counterparty and other party, or credit risk is the counterparties of the financial institutions like conventional banks or Islamic banks cannot able to pay its obligations to the banks. So that is what we call credit risk. So another risk is operational risk. This is a risk relating to the operations of the conventional and Islamic banks. We have also a legal risk. This is the risk arises because of the non-compliance of banks into compliance of some regulations of the government or the monetary or the central bank. So what we call a legal risk. We have also a reputational risk. Sometimes bank they have this risk arising because of the reputational risk. We have also a strategic risk. This is the risk that arise because there is we can say wrong in making strategies of the banks. They made some strategies, but these strategies give negative impact. So instead of positive, it becomes negative, so it becomes a strategic risk. We have also investment risk in investing. Sometimes banks invest in the wrong way or not in the good investment, so they incur losses. So we have also a profit risk. So there are many risks encountered. These are the sum of the risk encountered both by conventional and Islamic banks. But for Islamic banks also, we have also for Islamic banks particular, there are also risks to be encountered by the Islamic banks, like for example the withdrawal risk. Withdrawal risk is sometimes the depositors they withdraw their money from the banks. So this is a risk on the part of the bank because the the deposits are very important for the bank. There are also some risks like fiduciary risk, and we have the displacement commercial risk. Those are the some examples of the risks that can be encountered by the Islamic banks and conventional banks. But for the Islamic banks, there are usually some risks that are unique for Islamic banks, and that can be encountered by the conventional banks. For Islamic banks, they don't have this interest risk. But for Islamic banks rather, they don't have this interest rate risk. But for conventional, for Islamic banks, they have this withdrawal risk, fiduciary risk, and we have also a displacement commercial risk. That's all about the sums of the risks encountered by the bank. We will be discussing this in detail in some of our meetings. But for this moment, that's only about the risk. What are the risks encountered by conventional and Islamic banks, particularly the Islamic banks. So, demikian materi mengenai ini. Semoga bermanfaat dan selamat belajar. Saudara pemirsa UTI TV dan mahasiswa Universitas Terbuka dimanapun Anda berada, selamat berjumpa dalam program tutorial TV mata kuliah Manajemen Perbankan Syariah dengan kod EKSA4402. Pembahasan dalam kesempatan ini mengenai Liquidity Management in Islamic Banks. Bersama saya, Profesor Sahraman Haji Latif. So we will discuss about liquidity management. If you recall, we discussed in our previous discussions about risk management. So now we also discuss about liquidity management, how Islamic banks manage their liquidity. So before we go further about what is liquidity management and how liquidity management in Islamic banks, let us first define or know what is meant by liquidity. What is meant by liquidity? We have the term liquid. But in Islamic banks or in financial institutions, they have this what we call liquidity. Liquidity can be meant as the ability of the financial institutions or other institutions to meet its current or future financial obligations as they come or fall in due. In other words, when we talk about liquidity, this is the ability of the Islamic banks, for example, because we discuss about Islamic banks, is the ability of Islamic banks to meet its current or future financial obligations. Islamic banks, they have, or even conventional banks, they have obligations. In other words, they have borrowings, for example, obligations to other party, obligations to customers, for example, obligation to depositors. What is the obligation of the Islamic banks to the depositors? For example, the depositors, they deposit their money into the banks or into Islamic banks. This money is not owned by the Islamic banks. This is in deposits. So, if the depositors, they want to withdraw or get their money from Islamic banks, then the Islamic bank should give it. So, this is an obligation of Islamic banks to return the money to the depositors if the depositors, they need the money. So, when you talk about liquidity, this is about something, the ability, what is the ability of the Islamic banks to meet its current or future financial obligation, to pay its obligations. That is what we call liquidity. The ability of financial institutions or the ability of Islamic banks, for instance, because we talk about Islamic banks, to meet its current or future financial obligations or to pay its current or future financial obligations as these obligations come or full in due time, full due, or with the time that they need to pay. So, that is what we call liquidity. So, when we talk about liquidity management, so that's we define what is liquidity. So, now we have to go with the liquidity management. So, what is liquidity management? So, the banks, particularly Islamic banks, they need to manage their liquidity. If they also need to manage risks, they also need to manage liquidity in order for them to meet their current or future financial obligations. So, in order for them to pay their obligations, non-paying of their obligations, this will give a negative impact to the bank or the Islamic banks. Particularly, this will give to the bank what we call reputational risk. The reputation of the bank will be affected if the banks or the Islamic banks cannot able to pay their obligations in due time. So that is why liquidity is management is necessary. So liquidity management is the process or the way of ensuring business or ensuring an Islamic banks ensuring that Islamic bank has a cash available. So that is what we call the liquidity. It is the process or the way to ensure that Islamic banks, for example, or institutions have a cash available, or financial institutions has a cash available when needed. Or this is an effective and efficient way of managing the available liquid assets or cash to meet the short-term and long-term obligations, operations of the institutions or Islamic banks. So that is what we call liquidity management. It is an process, it is the way or of it is an effective way or efficient way of managing the available liquid assets or cash of the financial institutions like Islamic banks to meet their short-term and long-term obligations and other operations of the Islamic banks. So that is what we call the liquidity management. So what is the objectives of the liquidity management? So there are many objectives of the liquidity management. The liquidity management objectives, one of the objectives of the liquidity management, or these are the objectives of liquidity management. First is to ensure liquidity position of the bank as mandated or in compliance with the central bank of the country. So the banks, Islamic banks, need to maintain, to ensure that they have enough liquidity because this is also mandated in compliance with the monetary authority or the central bank of the country. So the country, the central bank of the country always ensures that financial institutions like financial intermediaries or financial institutions like financial intermediaries, banks, for example, or Islamic banks, they should maintain to ensure that they have these liquidity positions in order to meet their obligations. So objectives of liquidity management, of course, in compliance, to ensure or in compliance with the regulations of the central bank. In the case of Indonesia, of the Central Bank of Indonesia. Another objectives of the liquidity management is, of course, to manage the liquidity effectively, to manage the liquid assets of the Islamic banks or financial institutions in order to meet all the obligations of the company or the Islamic banks. So, liquidity management objective, one of the objective is for the proper management of the liquid assets of the Islamic banks in order to meet their obligations. Of course, one of the objectives also of liquidity management is to minimize idle funds. So, to minimize the idle funds, we need, of course, there is a liquidity management. Another objective is to ensure liquidity stability of the bank. The bank should ensure that they have this liquidity stability in order to meet the needs or to meet their obligations, in order that the bank will not be affected. If the bank has no enough liquidity, then this will give as I said, this will give negative impact to the reputation of the bank or Islamic banks. Liquidity management objective also is to ensure the sustainability of the business. Of course, if the Islamic banks have proper liquidity management, then this will sustain the operations of the banks. If the Islamic banks or conventional banks, they have they don't have enough liquidity, then the possibility, the sustainability of their operations will not be sustainable. So liquidity is necessary for sustainability of the business, or in the case of financial institutions or Islamic banks, sustainability of the operations of Islamic banks. Of course, we need liquidity. One of the objectives of liquidity management also is in order to meet the short and long-term obligations of the Islamic banks. To avoid or reduce defaults, we need liquidity management, because in order to avoid or reduce the defaults, so in order for the banks to not to encounter a defaults or delay in payments of their obligations, we need another objective of liquidity management is to reduce financial risk or liquidity risk. We need to manage the liquidity. We need to liquidate some liquidity of the Islamic banks in order that the Islamic bank will not encounter what we call the liquidity risk. And of course, liquidity management is important because this will enhance credit worthiness. In other words, on the part of the other stakeholders of Islamic banks. For example, the customers or the clients or the depositors, if they perceive or they feel that Islamic banks have enough liquidity, have a good liquidity management, then this will give them this will give an trust or positive perception on the customers towards Islamic banks. So this will give what we call credit worthiness. So that is also why liquidity management is important, or that is one of the objectives of liquidity management, enhancing credit worthiness. What are the functions of liquidity management? The functions of liquidity management, there are some functions of liquidity management. Of course, one function why liquidity management is important is what we call to provide stability. This will liquidity management will functions as a stability of the bank or Islamic banks. In other words, liquidity management provides stability, protection to depositors to save their money because it is safe. If the Islamic banks have good, effective, and efficient liquidity management, then this will give a good impression to the depositors to save their money into Islamic banks, because it means their money or their deposits are safe in Islamic banks. That is one of the functions of liquidity management. Another function is to ensure the availability of funds for the borrowers. Functions of the liquidity management also give an assurance to the borrowers that the Islamic banks or not only borrowers or the partners, we call these partners, or the clients of Islamic banks, it will give an assurance to them that there are available funds in Islamic banks. So that's how important liquidity management. It gives assurance that there are available funds for clients or borrowers from the borrowers. Available funds for the borrowers from Islamic banks. So another function is that liquidity management also liquidity management also function as what we call this is to avoid what we call selling of assets which are not profitable. Liquidity management is necessary or functions because this will give an what we call a way for Islamic banks not to sell their assets in a lower price or in a way that is not profitable. Because if you have a problem of the liquidity, if the Islamic banks have a problem in liquidity, so one way for them to solve this problem of liquidity is to sell their assets. So sometimes selling their assets because of the problem of liquidity is not profitable. They may be forced to sell their assets in the lower price. So this is not profitable for them. So to avoid this type of selling, then we need the liquidity management is very important. That is why one of the functions of liquidity management is, of course, this will ensure that to avoid the selling of assets which are not profitable. Another functions of liquidity management is to reduce the perception of customers to withdraw their money. What does it mean is that, of course, liquidity management functions, as I said earlier, functions because this is very important for the customers. If the customers feel or observe that the Islamic banks have no good liquidity management or have liquidity problems, then they tend not to to deposit their money or put their money into Islamic banks. So, liquidity management functions to reduce the perception of customers or Islamic bank customers or clients to withdraw or to withdraw their money. If customers feel that Islamic banks have a liquidity problem, then what they will do? They tend to withdraw, get their money, because they feel that the Islamic banks cannot able to pay them if in case that they need to withdraw their money. So what they will do is they withdraw immediately their money if they perceive that they withdraw their money in Islamic banks if they perceive that Islamic banks have a liquidity problem. So those are the functions of liquidity management. It's about stability. It's about the assurance that there are availability of funds. It's about to avoid selling of assets which are not profitable. It's about to reduce the negative perception of the customers towards Islamic banks. So those are the functions of liquidity management. In fact, there are many theories of how regarding the liquidity management. For example, we have also a theory what we call the productive theory of credit, or we call it commercial loan theory. This theory emphasizes that the role of the credit. Credit is very important. In other words, deposits, loans in financial institutions like Islamic banks or conventional banks is important because this will stimulate or help the economic growth, development, and productivity. So, in other words, the Islamic banks or financial institutions should balance this liquidity. It is not good for the bank to have too much liquid, to have too much liquid assets. It should be balanced. It is not also good for Islamic banks or financial institutions to have less liquid assets, because if there is a problem of less liquid assets, then this give an indication that they cannot able to pay their obligations or to meet their obligations. If also too much liquids, it means that their assets are not effective, not efficient. They are not efficient in utilizing the resources or the money or the deposits because the assets. They are not good in utilizing their assets because they have too much liquids. So the banks, Islamic banks or conventional banks, they should properly manage this liquidity. So demikian materi mengenai liquidity management of the Islamic banks and other financial institutions. Semoga bermanfaat dan selamat belajar.